If you want to be a great trader, then you're going to have to be able to read, unravel, decipher the price action. Now, in the world of technical analysis, they give us various tools to do that, and one of those is called price patterns. Now, they are very subjective, but can also help objectivity in your trading. Here I'm going to debunk the myths of price patterns, show you why you should be using them, how and why they should and shouldn't work, along with looking at the key price patterns you need to know and how we can improve the predictive nature of those patterns by adding and utilizing other indicators. And on top of all that lot, we're going to have a look at the rules you need to know if you're going to be using price patterns. So with all that, let's get on and have a look at those price patterns. So what are price patterns then? Well, there's not too much to them really. They're not that complex to calculate, work out. There's not much maths behind them. They're quite a visual sort of tool on our charts. They are also quite subjective, which adds in a bit of error sometimes to their utilization, but they are based around an objective rule set, which we will cover off, and I like as much objectivity in my trading as possible. But they are just simply pictures, patterns, formations that appear on the price chart, whether it's in stocks, commodities, cryptos, forex, whatever time frame. They work whether it's 1 minute up all the way to the weekly, monthly charts. They can be bucketed into different groups, which really helps narrow down our analysis and helps us massively. And very importantly, they do have some sort of predictive value. So why use them at all? Well, they're going to help you decipher and understand where the price has been, and in more depth, as well as also sort of working out, giving you that edge maybe for your trading as to where the price is heading next. Now, they can be traded as themselves, like direct price analysis, probably one of the faster tools you can use on the charts, because they're less lagging than most, but that can also create its own difficulties. I always like to enhance them with other tools, and we're going to look at that later in the session here. So to me, they can help you decide if the market price action is going to continue in the same direction, in the same trend, or is it going to move, reverse on itself, move in the other direction. But those two groups that they are bucketed into, I mentioned the bucketing of these patterns, are known as reversals and continuation patterns. So why do they work? Well, when people look at these patterns, they see the silly names and dismiss them straight away, but crucially they're painting a picture of market supply and demand, and our charts allow us to see that supply and demand battle fighting out within the charts, and by putting on these patterns it can show us who's winning between the buyers and the sellers in any given market or in any time frame, who's taking control of that price direction. And if we know that, then we can start to predict with a bit more certainty the future price direction. So on the flip side of that, then why don't they work? Well, I think a lot of users don't really appreciate that there's a lot of subjectivity to the whole approach, as well as following that basic objective rule set. It's sort of like the Pareto 80-20 rule, the 80% objective rule set, 20% subjective, but that 20% subjectivity has a massive impact on the outcome. But essentially they're rolled into one, and because they're so easy to use now, charts, to draw on these patterns, I think they get a bit misused and people get frustrated, fed up that they haven't done what they thought. They've believed that they're, see these patterns, they're a golden ticket, the holy grail, but they're not. And then the doubters come in and say, well, it's a great hindsight tool. And instead of just stepping back and appreciating what they're actually used for, and it's really just a simple tool to translate buying and selling action and give us suggestions, not definitive answers as to where the price may be going next, with a bit more probability. And that's what we're looking for in trading, to get our edge. So a big tip here, another reason why they don't work is because users of these patterns just treat them as is. In my experience of using price patterns, they're very risky to trade on their own, and they have low odds of probability of outright success. Now, to improve that probability, I think you've got to stack these patterns on top of other tools to increase your odds of ascertaining correctly the potential future price direction of any market. So, big takeaway, remember technical analysis and these price patterns, it's a science with a lot of subjectivity thrown in. Use them as an additional tool to your armory, one to like I say, put the edge, the odds more on your side. So we talked about these two groups, and we're going to go into now the key patterns that you need to know. We're going to break them down, like I said, into the reversal patterns and the continuation patterns. On the left, they're the key ones, the reversal patterns in their heads and shoulders, and you have an inverse heads and shoulders as well. That's the opposite of that. Double, triple tops and bottoms, saucers, spikes and reversals. Like I say, weird names, but they actually are, say what they do on the tin, really. Once you find these patterns, they look like, their name set. And then on the right, continuation patterns, you'll find these are mostly triangles and wedges, and they're broken down into different types of triangles and wedges: symmetrical, ascending, then we've got our flags, pendants and descending. So what we're looking for is a price pattern that indicates a change to the current trend. That's really what our reversal pattern is all about, and they occur when, or most often, when the bulls, the bears, their trends are running out of steam, running out of momentum, and they literally turn on themselves. And these price patterns are, like I say, a fast tool of working out whether that's likely to happen or not. So our first pattern here is the head and shoulders, and you've got to visualize it like that. We've got on the left side a shoulder, on the right side a shoulder, and in the middle the head, and the red dotted line there is the neckline. And we're looking for that trend, most important here, that first principle there, that trend to be pushing on up in to that shoulder. Then that pattern creates itself, the shoulder, head, shoulder. Then it breaks down. Now, if you're a more aggressive trader, you could, sell that there as it breaks through. A lot of people, are more conservative. They wait for the pullback to confirm, the short trade back to that neckline, and then go short there. So heads and shoulders is a very strong pattern, quite hard to find. And remember, when you're finding these things, it doesn't always look exactly like it does in this example here. You might have a bit of a wonky shoulder to the left, a skewed head to the right, but it's the principle, the basic setup that you're trying to find. It's that subjectivity, like we talked about, that skews the analysis and gives people, different analysts, traders, different results. But take this as the sort of basic rule set to follow when trying to seek out these patterns. And I mentioned the reverse of the head and shoulders, called the inverse head and shoulders, and this is a bullish setup. The trend has been coming down, and it's literally just the opposite play to our head and shoulders, which is the bearish setup. And the targets, what do we want to look for in terms of, once that price breaks through the neckline? Well, you take the distance from the top of the head to that neckline, and then you lay that out from that break point to give you your first target zone. So like I say, heads and shoulders patterns are very useful if you find them. So we'll have a look at a few examples now in the real world. So we've got here Australian US dollar forex pair, and as you can see, we've got the head and shoulders pattern playing out. I've drawn on the height from the top of the head to the neckline and projected that down under that as my potential target. We can see the trend coming up on in, and you could say, well, it's not perfect heads and shoulders, and that's that subjectivity again. The right shoulder is a lot wider than the left shoulder, but it's got that basic pattern, and as it breaks through, it nicely takes down to our target. And another example, Peloton, the US stock, the fitness stock, did very well in lockdown. We can see the price bouncing up, and then we've got the two shoulders, very similar to our last head and shoulders pattern, and then the projection down under that neckline break, and we can actually see a false break in the middle there. You remember what we said about some people a bit more conservative and wait for the pullback? That's what happened here, and then made a stronger shoulder and then broke down again, came back, tested, and then went further down round some poor earnings news. But that's another nice typical example of the head and shoulders pattern. So moving on to the double bottom, and it's a double bottom for a reason. It's just a double touch, as you can see there, at the bottom of the trend coming down. It's a bullish setup, it's a reversal. How do I get a target? Well, it's that middle point from the height of the double bottom to the middle, like I said, the top there of that peak in between, and then projected on upwards. And that is simple, very common pattern that you will find on the charts. Here's an example of it on gold, and I've laid on a few numbers and to give you an idea of like I say, a more practical example. We've got the double bottom in place there, then we would project that middle part as a potential price target area. So in this instance, we're looking for the price to move up to about $1,400, and I've put on Fibonacci lines here that can also help aid the strength of these patterns, but we're going to look at strengthening their probability later in this video. So the double top, that's just the flip side, exactly the same rule set but done in reverse. It's a bearish setup, the trend's up, double top, our projection down through the height of that is our target. So not much to it, just like I say, another very common pattern and the opposite of the double bottom. And it's the same story really for both the treble bottom and the treble top. It's just touched more times. It's more significant, the treble touch than the double touch when it breaks, so it's probably a better setup than the double bottom, double top. And the target is exactly the same process, and we can see nicely as well on the treble top drawing there, the same thing happening out but in reverse. And then a couple of other patterns to consider. On the left hand side, we've got something called the saucer, and like I said, it is what it says on the tin. It's shaped like a saucer, and sometimes you get a handle, like the cup and saucer type thing, or to the right of the chart. But this one on Cocoa, New York Cocoa monthly chart, didn't. It's just a saucer pattern. It was a bottoming pattern, and then off it runs on up. And then on the right hand side, we've got something called the spike or the V reversal pattern, and it's a really sharp shock to the price, and it's married in with heavy volume. As you can see here, this is LME 3-month lead price, and these happen very quickly and without warning, and you can see here that reversed on back down after that sharp spike. And it's the same, that was a bearish setup. Opposite rules again for bullish. You can see that spike to the downside as well, and often they can be created these days by algorithmic trading, fat fingers, news events, that sort of thing. So very fast, and watch out for those. So the rules you need to know for reversals, well, there's a few of them. There must be an existence of a prior trend, very important that. You can't just make these patterns up, you've got to look for that prior trend. The first signal of reversal is often breaking an important trend line, so look out for that trend line. The larger the pattern, the greater the subsequent move. Topping patterns are usually more volatile than bottom patterns, so expect that maybe bigger move down reversal with those. And bottom patterns have similar price ranges and take longer to build, and reversal points normally coincide with heavy traded volume. So if you can add volume to your charts to watch out and marry into the patterns. Remember, Forex doesn't have volume, so don't be misled to believing it does. It's not going to help you there, so you're on your own on the patterns in reversals for Forex. And volume, as it says there, very important, or usually more important to the upside. And some target rules. Target for a reversal pattern is calculated from the highest peak to the lowest trough. In the wedge pattern, the objective is calculated by projecting the target up down from the breakout point. So let's go on now to the continuation patterns. And continuation patterns, we're just looking for the price to move out of a consolidation period, a sideways malaise, and then continue in the way of its previous trend. Now, continuation patterns are often shorter than reversal patterns, and they occur most often in the near term to intermediate time frames. So something to think about when you're building strategies out there. Now, there are four main types, and they're all based really around triangles. We've got our symmetrical, ascending, descending, and expanding, broadening. Now, I've put there some basic rules, what you want to look out for when spotting these patterns. Now, the symmetrical, you want to look for 4 touches within inside the pattern, and it normally breaks out about 2/3 inside the triangle. So instantly there you've got a time limit on a trade, potential trade idea as well, which I like when using those type of patterns. And you can apply that 2/3 rule to like ascending and descending as well. Ascending, price height of pattern at widest, add onto the breakout point, that's for a target, and vice versa for the descending triangle. And then our expanding, broadening triangle, very rare, hard to spot, made of 3 higher peaks and 2 declining troughs. So now let's have a look at some symmetrical patterns. And on the left we have the bullish setup. Notice the amount of touches inside, and our target there is by taking the height from A to B and then projecting it from C to D, but also look below for volume to be high on that breakout. And notice the trend before has to be in existence in that direction, coming into it for that bullish setup. And it's exactly the same for the bearish symmetrical triangle, but in reverse, but you're still looking for big volume. Now, the ascending, descending continuation patterns, not really much different to the symmetrical triangles. The only difference really is we're looking at flat bottoms and flat tops to that triangle pattern. The descending one has a flat bottom and the ascending a flat top, and again both are confirmed using that higher amount of volume. So I've got an example for you here. Alibaba, the Chinese Amazon competitor. It's an older chart, but it gives you an idea of some of those patterns in different time periods and how the price broke up after that breakout. And also notice how, for example, volume levels also increased as well. And another example more recently, US dollar against Japanese yen. We can see our A and B, project that to the C and D, and you can actually start to get risk return numbers out, whether the trade was worth doing in the first place. 2.23 to 1, so that's not bad. And you're going to put a stop loss in there, which I highly recommend. Then use the other side of the triangle pattern, the below side, if you're a bit more conservative. Some people who are a bit more aggressive will put the stop within the triangle, but under the top flat line out part there. That's up to you. It's make that part of your trade rules and be consistent when you do your trading. And here's another example to the downside. It's sugar, number 11 contract, futures contract. Again, we've got the trend coming down, we've got the flat bottom, and the price. If we were trying to anticipate where it's going next, we'd take the height of that pattern, the AB, and then do the CD to get a potential target. Now here's one of our rare patterns. It's the broadening pattern. You can see it getting wider, a bit like a megaphone, and then it breaks on down. Rare to spot, and really it's something I don't come across or use that much. And we've got some derivatives of our triangles known as wedges, and there's two main types, the falling and the rising ones, and visually they look like this. On the left we have the bullish setup, trends up, then we got that narrowing wedge, and then it breaks on out. That 2/3 rule still in place there, and it's the same for the rising wedge. To trend down, the wedge pulls back up and then breaks on down. Again, A, B and CD for any potential targets. So our next sort of final set of patterns are known as flags and pendants, and I really like these. They're very useful, very common. Again, working all different time frames, all different markets. They're again just a consolidation, a pause in price action within a range. Very reliable, even more reliable when you add them together with different tools and indicators. Both bullish and bearish setups can be had from these. The bearish rules are just the opposite of the bullish ones. I'm only going to look at the bullish setups here, but just take them in reverse if you're using them to spot bear markets. So on the left we have our flag setup, and it just is what it is. It's the flag. Imagine it as a flag, and we have the flag pole, and often that follows a consolidation pattern. And what we do is we take the A and B and project that as the C and D, and again we're looking for high volume on the breakout. And our pennant, exactly the same principles. It just looks like a pennant. We still got the flagpole, and it's the A, B, C, D projection for any targets. So again, some useful chart patterns, those two. And here's an example on the Swiss SMI. It's the Swiss Stock Exchange daily chart, and we can see our consolidation pattern down the bottom left there. Then the A and B flagpole projected back on upwards for a potential future target. And I found this really old chart that I got from my Bloomberg terminal a long time ago, when I was on the trading floor, and I was just drawing on random patterns just to show what you could see differently in there. We got double bottoms, we got pennants, flags, symmetrical triangles. But there's a saying in technical analysis, you put 100 analysts into a room, they'll give you 100 different answers, and it's exactly the same. I look at this in a completely different way to you or someone else and come back with a completely different set of price patterns. That's what makes trading great, and why we all get different results. That's the beauty of it. But you start to use these tools, these patterns, and then start to add other tools in the mix, and then that's how we will start to strengthen the probabilities. And that's what we're going to look at next, is strengthening the predictive nature of these chart patterns. Now remember I said that from my experience I believe that price patterns on their own aren't good enough. You've got to add indicators, and it's all about putting the odds on your side. It's about getting the edge in your trading strategy, and we need to strengthen it, and we do that by adding independently constructed tools. And there's a very important rule in technical analysis called the rule of colinearity. So it's another tip for you here. It's avoiding the cardinal sin of multi-colinearity amid indicators. What does that mean? It's just simply it's the multiple counting of the same information. So it's when you put different indicators together, if they're all off the same stuff, you're basically getting the same answer. So you might as well have just used one of them. You want combinations that come from different sources. So you might have one from a closing price, you might have one from volatility, you might have one from volume, you might have a sentiment indicator, and you might have a fundamental indicator. It's about putting combinations together, but when they all line up independently, from each other, they're all giving you the same answer to buy, then you buy. And that's what we want. We don't want it all off the same stuff. So a couple of examples for good and bad combinations there if you're purely a technical analyst, but something definitely worth considering when you are putting together a tool set to do your trading. And I'm going to have a look at a few examples now just to give you a general idea of how to start that thinking process. Now, this is our USD JPY chart that we looked at, if you remember earlier, and here I've just added on Ichimoku cloud. I've stripped back the Ichimoku setup. So my rule there is if the price is above the cloud, it's bullish, below it bearish, and at the bottom here I've got directional movement indicator, and I've taken out the ADX and left a DR plus and DR minus on there. So if the blue's above the red, it's bullish when they cross, and vice versa. I've got the cross down there, so that equals bullish. I've got the price above the cloud, the Ichimoku cloud, which is bullish, and I've got that breakout of the pattern. So I've got three long positives for me. So I'm going to go in, and then I'm going to do my risk return, as you can see we looked at previously, for my potential target on the trade, which had a good risk return. That's a simple way of adding indicators and tools to strengthen, give you more confidence that your idea is right. And you can also do it on other charts. Here I've got crude oil on a Renko chart, and I've added a stochastic indicator. We've got a double top on there, so it doesn't necessarily have to be patterns used on standard charts. They work across all chart types. We're looking for a quick risk reward of 1-to-1, and I'm just marrying in stochastics for my exit. So when the market becomes over sold and comes back up through the 20 line, I get out as that crosses over, and it's a nice trade. It's just showing you how you can use patterns on different chart types. And another example, Heikin-Ashi chart, smooth out the data. This is a bearish trade on ultra bond futures. We've got our triangle pattern. We don't go in when it breaks out unless our DMI red line is above the blue line, which it is, and the price is below the Ichimoku cloud. It takes a bit longer to get to that target, that AB becoming CD, but it gets there in the end. But you can see there how you've structured a rule set that then just makes trading a lot more consistent and disciplined and easier to action and execute. So some continuation rules you need to know. Always identify the area of sideways price action. Continuation patterns are quicker to develop than reversal patterns, remember that, and they can flag up major trend importance, significance, breaks, when they come out of the triangle pattern in the longer term, but they're also very useful in the shorter term, especially like flags and pendants. And the price target in an uptrend is measured from the start point of the trend and the breakout point at the base of the trend or most recent congestion pattern to the highest high, and the move is then projected up from the point of breakout to arrive at the target, and vice versa for a bearish setup. So let's just have a quick look now at how we would draw these patterns onto a chart. I'm going to use TradingView as my example, but just to give you an idea of how I go about looking for these patterns and then drawing them on. So if you are using TradingView, then you've got the same as me, but this whole process exactly the same on any chart package, and got up in front of me the Australian dollar against the US dollar daily chart, and really my first job is just to see if any patterns hit me, straight away. And what I'm noticing here is the heads and shoulders pattern, so I'm hoping you can also see that. A lot of it does come down from experience and looking at enough charts so you see stuff very quickly, but as you get more experience you will see that sort of stuff. And how am I going to draw this? Well, it's just the trend lines here. So you see we've got our head coming here. I'm only going to draw this really quickly. We've got this elongated shoulder here. Let's put that shoulder in there. See, remember the rule of subjectivity. It doesn't have to be perfect, okay? Then we've got our neckline in here. Remember our target sort of area. So let's see what sort of target we've got. Is that there? Then if we copied and paste that and moved it down from that break, I'm more aggressive as a trader, so I'd go straight in. It actually does hit nicely our target. You've also both the conservative ways as well, because look what happens, the price pulls back to the line and then breaks down. So I'd have taken a bit more shorter term pain, but as long as it doesn't break back above that, then it comes on down, hits our target quite nicely. So again, look for the different patterns. It's quite subjective. I could just be here all day drawing these sort of things. We got that, and then we've got a break on upwards, from here. So if that was our pattern there as our potential target, add that on, and yeah, that hits it again nicely. So that's what you want to do. It's just simple trial and error, playing around, getting experience, and seeing how different markets behave going to different time frames. That's a longer term setup, but it can also help you create rule sets around it. So you're in a daily time frame here, and you've got a reversal in play or a continuation in play on the trend. Then build that into the shorter term signal, so you're only going to take them in the direction of the breakout, or for example. So think of things like that. But there you go, there's a simple example of just drawing the stuff in practice. So I've also put together a patterns cheat sheet that you could take a screenshot of and keep it close to you. It's going to take in all the different patterns that we've looked at in our video here. Keep it close, and then you can refer to it quickly, but as you get more experience they're going to come naturally to you anyway. But let's have a look at that now. There it is. Let's say do a screenshot, pause the video, and print it off if you want to, or just keep it on your phone by seeing until you get familiar with those patterns. But from the top we've got our price reversal patterns, both bullish and bearish, categorized out by name, and then below that we've got our continuation patterns, both bullish and bearish as well. So if you start to recognize these patterns more and more, take note and action accordingly. So there you go. I hope you found that quick tutorial on price patterns useful, and that you can apply it into your trading. Let me know in the comments below what you think of it. What patterns do you use or have come across in the past? What experiences you have? Love to hear from you there. And if you want to discuss it in more detail, ask me more questions, then we run a free traders club on Discord at TheStopHunter. I'll put the link in the description below for you to follow if you want to join, and like I say, carry on the discussion all around technical analysis and trading. Free to join, all are welcome. Other resources as well, I'll put in the link links in the description below and on our website www.TheStopHunter.co.uk. Well, if you liked today's video, please give us the thumbs up. Don't forget to hit the subscribe and bell buttons, and all that's left for me to say is thanks for watching, good luck with the trading, and I'll see you in the next video.